Right, let's quickly recap money laundering. First of all, what is it? Create an appearance that money from crimes actually came from a legitimate source. So think drug dealing, money from drug dealing, pretend it didn't, pretend it came from somewhere else. A wider definition of that as well is available where it says, look, it's any activity that generates an asset illegally. And so that will include things like tax evasion and false accounting. Okay, we then moved on to say, well, it becomes really important. So the Financial Action Task Force was set up to try and combat all this money laundering, basically drug dealing internationally. And it came up, look, there should be certain standards and policies that we should have, that all auditors and accountants and professional people should have. Customer due diligence, know your customer record keeping, record any suspicious transactions, make sure that all your persons, you know who they are and they're not hiding behind companies, etc., and that we all cooperate internationally. All good stuff then. So the scope for auditors in terms of money laundering, make sure you create a money laundering reporting officer, because if you don't, then that is actually a money laundering offence. If you don't try and be aware of the risks of money laundering, that is a money laundering offence. If you don't do customer due diligence, that is a money laundering offence. If you don't report suspicion, that is a money laundering offence. And if you tip people off, that is a money laundering offence as well, as is tax evasion and false accounting. So it's a real minefield for auditors. And so it's really important then that auditors and accountants can be protected. How do we do that? By making sure we do report suspicious transactions, unless we can have a reasonable excuse for not doing so, i.e. I was worried that I might get hurt, that's enough. You thought the transaction was legal, you reasonably thought that it was a legal transaction. You have an anti-money laundering culture running throughout your firm. All your employees are aware of it. They're all aware of where their money laundering risks are, and we have procedures for dealing with that. And we also have a money laundering reporting officer. Even when they're away, we employ a deputy for them. We keep great records. We keep great know your client, customer due diligence stuff, and we train staff all the time. All those will make sure that you're not committing money laundering offences. Really important then, know your client, know who might be doing money laundering. How do you get to know them? By understanding their business patterns and models. And then if you understand them, well, then you know that anything that's out of the ordinary, like where does this income come from, out of the ordinary for your normal business pattern and model, that becomes a suspicious transaction, doesn't it? So what do we have to do when it comes to, we've got this suspicious transaction, when do we report it, or how do we report it? Well, it's a criminal offence not to report it, regardless of the amount. Even if it's a small amount, you have to do it. Good news is you don't have to quantify how suspicious you are, and you don't automatically have to resign from the audit, because if you did, you might be tipping people off, but you might want to resign anyway. When you do come to report it, which should be in a timely fashion because it is a crime, you talk about, right, this is the business, these are the details of who you suspect, this is their role, these are the references we've had, these are the transaction details, this is where we think the money is. You report all of those. We said you don't have to automatically resign, but unless it's in your commercial interest to do so, you are a business after all, or unless there's ethical reasons why you think you also should resign. But remember, no tipping off. What is transaction? Large cash amounts, obviously, unexplained foreign transactions, and finally, no business sense transactions. Like we said, if you understand the business model, you're unsure where this has come from, looks a bit odd, that's a suspicious transaction. So what you should have then, overall, is a big anti-money laundering program, dedicated resource to it, like a money laundering reporting officer who has appropriate responsibility and standing in the company and is experienced and skilled enough to do it. You have written procedures which identify the risky transactions, the large cash balances, the foreign transactions, those that don't make business sense, and you have technologies that help you identify them as well. It covers all aspects of your client's business. You make sure you do your reports on a timely basis, and you have culture, you have training, you have regular reviews of the anti-money laundering program so that you're always safe. There are 3 stages to money laundering that you need to be aware of. You might see this. First one, where the dirty funds get placed into your financial system. Then you try and hide them by passing it through lots of different procedures and accounts to leave no audit or to leave a confusing audit trail. And then finally, you say, right, now I'm going to buy a clean asset with it. and therefore I've now money laundered. I've gone from dirty money when I placed it to clean assets when I've integrated it.